All right. So the TSP allocation strategy. So now that we talked about your savings rate, how do you maximize your TSP return every year, right? What is the best way to get an 8% average annual return? The truth is that no one can control how the stock market performs, but we can have educated guesses on if there's going to be a recession this year or if this is going to be a bear market this year, right? And you can always do uh, the risk assessment inside your portfolio in your TSP. You probably don't want to put all of your money in bonds like G and F funds, right? Or put all 100% into an S fund that's on a higher risk. So the the TSP has five core funds, and if you can't remember which one is which, I have a way for you to remember them. C stands for common or common stock index fund, and I know this one is kind of confusing to memorize, but just remember that common stocks mirror the performances of the S&P 500 index with Apple, Microsoft, Amazon, Google, JP Morgan Chase, and other big US stocks. And S fund stands for small or small cap stock index fund, and it's the highest risk of all core funds because they track smaller companies like Uber, Square, Snapchat, Lululemon, and that are more volatile in the stock market. And I stands for international stocks outside the US. If you say ever heard of Sony, right? Louis Vuitton or Toyota, the I fund actually follows the MSCI EAFE index and tracks all of those companies and many more in Europe, Asia, and Australia. And F stands for fixed or fixed income index fund that tracks over 12,000 notes and bonds from the US government agency securities, corporate bonds, and mortgage backed securities. And it matches the performance of the Bloomberg Barclays US aggregate bond index. Okay. Try to say that twice. And G stands for G unit. No, it doesn't. I'm just kidding. Sorry. Bad joke. G stands for government or government securities investment fund that basically tracks the short term US Treasury securities. And they're guaranteed by the US government. And there's no credit risk unless the government goes bankrupt, then which would be bad. And then we will have bigger issues to worry about at that point. And L stands for life cycle or the target retirement funds that are mixed with CSIG and F funds, but they're designed to automatically allocate those funds based on the life cycle fund you choose. The TSP actually automatically enrolls you into the life cycle fund based on the year you reach 60 years old. And when you choose the life cycle fund, you should choose based on what year you reach your normal retirement age and not your early retirement age. And let me break it down for you. The first strategy is the life cycle fund if you just want to invest and forget. That is the laziest way to invest if you don't really want to stress about the stock market. However, if you haven't logged into TSP and you became a federal employee or a member of the armed forces before 2018, your TSP is most likely all in the G fund. And I know they changed that recently. And it's so crazy that the government just put clueless people who didn't know how investing worked, just put everybody's money into the G fund. Who benefited from that? The government, right? But anyway, your money should be in the life cycle fund in accordance with your current age. Either way, you need to log in today and find out what you're investing in currently. When you choose your life cycle fund in the TSP, the first thing you want to do is calculate what year you turn 60 years old because you're eligible to withdraw from your TSP tax-free and penalty-free at 59 and a half. And I turned 60 in the year 2046. So the life cycle fund 2045 would be the best option for me. The L fund is a diversified mix of the five individual funds that I mentioned earlier between CSIG and F funds. And about every quarter, TSP adjusts the target allocations to shift gradually from higher risk and higher reward to lower risk and lower reward as they get closer to your target retirement date. And in the year 2045, my 2045 L fund will be rolled into the L income fund. And keep in mind that the L fund target allocation will stick to its risk reward target no matter what the market does. And if the C fund or S fund loses value significantly due to a bear market, the L fund will still rebalance it at the end of every trading day to make sure it maintains the target allocation. So it's not always a good thing, in my opinion, to have a life cycle fund. The 2045 life cycle fund is the right choice if you're going to turn 59 and a half between the years 2043 and 2047. The allocation in this portfolio right now is 15% G fund, okay, and 7% F fund, 39% C fund, 10% S fund, and almost 27% I fund. The allocation in this portfolio, as I talked about, is pretty conservative. And if I add them up, that's about 22% bonds and 78% stocks. Okay. So as years go by, the CSI funds will have less money allocated to them, and more money will gradually go into G and F funds. All right. So let me show you this. I want to show you the 2035 instead. Okay. And if you look at the 2035 L fund here, you see how the G fund is now 27%, F fund at 7%, C fund 34%, S fund at 8.8%, and I fund at 23%. That's a lot of I fund too. So this is about 34% bonds and 66% stocks. Okay, so this is like 2035. So about 10 years out from retirement, it's already investing at 35% bonds and 65% stocks. As you get older, your stock bond allocation will change from being risk tolerant to being risk averse. The purpose of these changes is to preserve your capital as you get older. And the downside of investing in the L fund is that it usually underperforms the S&P 500 or C fund, because every year that goes by, the life cycle fund is putting more money towards bonds. And I chose not to invest in the life cycle fund because it's been underperforming the C fund, which is the S&P 500 index. And it's very common for investors to use it as a benchmark, okay? And I choose to be more exposed to stocks than bonds while I'm still in my 30s, right? It makes sense. Now, let me show you the 2030 life cycle fund here, okay? Look at the 10-year annualized return. It's only 7.1%, 7.08% if you compare that to the C fund at 12%. So in my opinion, I think these life cycle funds allocate too much money into bonds that perform a 2% average annual return. So in other words, they're way too risk averse or conservative to grow my retirement fund at my age. This is why I chose the individual funds so that I can do the allocation myself. Okay. And I'm going to show you something else. I told you guys were going to get so much value out of this live stream. By the way, if you're interested in joining my private individual, couple, or group sessions, or my private Facebook group, you can sign up for my private membership group on my main YouTube page or by visiting firesightchat.com/coaching to discuss your financial independence journey. I'm going to show you the other thing. So when it comes to how do I allocate it myself, right? I know it's called Rule of 120, okay? This is free information, okay? You don't even need to pay $3,000 to your financial advisor to find this out, okay? The Rule of 120. Historically speaking, the investors or the financial advisors would recommend Rule of 100, but people are, they're living a lot longer now and they're retiring earlier, so now it's more like a Rule of 120. Okay, so it's a very simple calculation for 120. You basically do 120 minus your age, okay? And that gives you stock bond allocation. Okay, this is not financial advice, but this is a very good starting point if you don't know how much you should allocate. Okay, so let's say you're 35 years old, all right? Then it's 120. You know what? I don't like red. Let me go to blue. Red means threat. Okay, 120 minus 35, that gives you 85. Okay, so that will be 85% stocks. Okay, that will be the allocation. So that gives you 85% stocks, and 15% bonds. So let's say you're 20 years old, or let's say 25, then that's 95% stocks, running out of space, and 5% bonds, right? So it has some similarities to the 60-40 strategy of holding 60% stocks and bonds, but it's much more aggressive than that. It's a good starting point if you don't want to invest in a life cycle fund, but it doesn't mean that you can't be flexible with the risk exposure. Okay. This is a rule of 120. It's just a rule of thumb. You don't have to follow it, but it is a great starting point. Okay. And again, we used to do rule of 100. I appreciate you guys tuning in. If you're just joining, I really appreciate you guys being here. So we used to do rule of 100 until we all started living longer and spending more years in retirement. You also don't want to just rely on the rule of 120 because you need to take many things into consideration. Like if you have health problems that require you to preserve your capital more, or if you have kids with a disability that require you to take care of them for the rest of your lives. So the bottom line is that the rule of 120 is a good starting point to help you calculate your risk exposure based on your age. But it's not a model that you blindly follow without taking other risk factors into consideration, right? So before you choose your TSP individual funds, you need to first assess your overall risk scale. What's your current age and retirement age? And are you close to your retirement? Are you more risk averse or risk tolerant? And when it comes to or risk tolerant when it comes to investing, and do you prefer just to invest and forget the TSP so that you can be hands off, or do you prefer to be more hands on with how you want your money invested? And when it comes to G and F funds, they're really there to adjust your risk scale because stocks and bonds typically don't move in the same direction. Historically speaking, well, not counting the year 2022, because that was a crazy inflation year. And we're still dealing with inflation right now, where both equity and bonds crashed pretty hard, right? But historically speaking, when the stocks go up, bonds tend to go down. When bonds go up, the stocks are down, right? And investors want to be more risk averse due to a recession or some kind of economic catalyst, right? But is investing your entire portfolio in G fund or F fund going to help you grow your wealth? Of course not. Unfortunately, I know so many people who put money in G or F funds because they were so fearful of what was going on in the stock market. And back in March and April 2020, the stock market crashed due to the complete economic shutdown, right? Across the country. Do you guys remember that New York Stock Exchange actually had to stop trading because the Dow was what was it? Dow, Nasdaq, and S&P 500 were all down by 7% to 10%, right? So what ended up happening in 2020? It finished with an 18% return. And what happened in 2021? It finished with a 28% return, right? So, but what happened in 2022? The S&P 500 or the C fund finished with a negative 18% return. What did some people do instead? They just reallocated their entire portfolio from CS and I funds to G fund and continued buying into the G fund, right? But I know some people made a different move by moving their entire portfolio into a G fund and bought CS and I funds throughout the year. All right. Some people even got screwed. I can say that on YouTube, right? Some people got screwed by thinking that F fund would be safer and lost 12 or 13%. It was, about 13% in 2022. Look, none of us can predict how the market will finish by the end of the year. Right now, we're in April. Who knows how the market's going to finish in December, right? Not even those stock market experts can predict that. But am I going to shame people for putting their entire portfolio from equity to G fund? No, I won't. But I did something different from many people. What did I do with my money in my TSP last year when the market was down as much as 30%? Nothing. I just continue to invest in the same equity funds that I had. And I wasn't buying CNS funds at a loss, right? But I was buying them with a 20% or 30% discount, right? And I didn't care how the market performed last year because I'm not going to touch any of my TSP for another 22 years. And but if I'm 57 or 58 years old, say I'm very close to my retirement age, then I would be more concerned about capital preservation if TSP is the only retirement vehicle that I have. Then I want to make sure that I don't lose 20% of my investment when I'm getting ready to retire next year, right? This is why we all need to assess our risk management every year to make sure that we don't just put all of our eggs in the same basket that is either way too risky or way too conservative.